Good morning, everyone. Well, the profit-taking having ended, the dollar rally could continue yesterday. The dollar gained against most of its counterparts, the one exception being the Australian dollar, after the U.S. retail sales number far exceeded market expectations. That's, of course, an important indicator for an economy based largely on consumer spending. Note, too, that the average work week in last week's employment data was the highest since World War II, which indicates that factories are running flat out. They can't add much more overtime, so they'll probably have to start hiring more people soon. In other words, there's starting to be a virtuous circle in the U.S. between higher spending leading to higher output that should result in higher employment, leading to higher spending, and we support the trend further. That suggests to me that the risk-on dollar may well be able to keep moving higher too. As I said, the one exception was the Australian dollar, which bucked the trend because of surprisingly strong employment data in Australia. Now, as you remember, last week we had 5 central bank meetings. All the central banks were on hold. Today we have the Norges Bank and the Swiss National Bank, which are also likely to be on hold. And overnight we had a meeting of the Reserve Bank of New Zealand. Guess what? That was on hold too, as was expected, so no surprise there. But the statement following the meeting was much more dovish than expected. In fact, they specifically stated that, quote, "we expect to keep the official cash rate unchanged through the end of the year," unquote. With the drought there, quote, "creating difficulty in much of the country," unquote, the likelihood is that they will not want to compound the nation's problems by causing their already overvalued currency to appreciate further. As a result of this change in stance or a nuance, we expect the Kiwi to fall further from a fundamental point of view. From a technical point of view, Kiwi's downtrend has been rather reliable since mid-February, as it's converged to its 200-day moving average. With the pair approaching a 4-year-old support trend line, traders may want to consider placing short positions with a target of 81.35, just above the trend line and the 38.2% retracement of the June 2012 to mid-February up move. The downward sloping trend line resistance for today is at 82.20. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.